This is Al Brooks, and this is my price action trading course. This current module is about buying and selling pressure. Bars often show that either the bears or the bulls are stronger, and the price action that favors the bulls is called buying pressure, and when price action favors the bears, it's called selling pressure. Both the bulls and the bears are constantly trying to create pressure. The bulls are trying to buy enough to make the market go up. The bears sell to make the market go down. And their activity creates footprints, and those footprints indicate pressure. When there is a preponderance of buying pressure in a bull trend, it's clear that the bulls are in control, and the clarity is due to the buying pressure. So when you look at a bull trend, you know the bulls are in control, and you know because you're looking at buying pressure. There are signs that the bulls are in control and that the market's in a bull trend. What are some signs of buying pressure? Here's a list. I'm not going to go through the list all in one part. I'll do it in sections. One of the obvious indications that the bulls are in control is that there are more bull bars on the chart than there are bear bars. And the bull bars on the chart are bigger than the bear bars. And there are often consecutive bull bars, like 2 or 3 or 4 consecutive strong bull trend bars. Small tails on top, big bodies. The bars tend to close near their highs. The tails on the tops of the bars are small or non-existent. There are also series of bars where there are no pullbacks at all, microchannels, bull microchannels. There are tails at the bottoms of the bars. When the bars sell off, going into the close of the bar, they buy it, and that puts the close higher up in the bar, and it creates a tail at the bottom of a bar. There are also breakout bars with gaps and follow-through. So when a bull bar closes above the high of the prior bar, that's a gap between the close of the bull bar and the high of the prior bar. There's follow-through. The next bar is a bull bar. Also, as buying pressure increases, it's represented very often by a number of consecutive bull trend bars. So you might get 2, 3, 4, 5 consecutive bull trend bars. Also, the bull bars start to get bigger and the bodies start to get bigger. Also, the number of consecutive bear bars decreases. So, for example, 20 or 30 bars ago, there may have been 2 or 3 bear bars, and now you rarely see 2 bear bars in a row, and the bear bars tend to be getting smaller, and the bodies tend to be getting smaller. Selling pressure in a bear trend. When you look at a bear trend, you know that the bears are in control. The market's going down and to the right, and you know that's due to the bears. And the reason why you look at the chart and it's clear to you that the bears are in control is selling pressure. Again, here's the list that I'll be going through of things that are evidence that the bears are in control. Every one of these things on the list is an example of selling pressure. The first obvious example is if there are more bear bars than bull bars, that's a good sign of selling pressure. And if you start to get a series of 2, 3, or 4 bear bars. Also, if the bear bars are bigger than the bull bars, the bodies, if the bodies of the bars are bigger than the bull bodies, that's a good sign of selling pressure. Are most of the bars closing near their lows? Are we starting to see bear microchannels? 4, 5, 6, 7 consecutive bars without any pullbacks? Are there tails on the tops of the bars so that the market is trading up as the bar is forming, and then going into the close, it trades down and it creates a tail at the top of the bar? Are there bear breakout bars with gaps? In other words, is the close of the current bar below the low of the prior bar? Is there a gap between the close of the current bar and the low of the prior bar? Is there follow-through? Is the next bar a bear bar, and the bar after that a bear bar? Increasing selling pressure. Are we starting to see a series of bear bars in a row. Was the last time we had consecutive bear bars when we had 2 in a row, and now we have 4 or 5 in a row? That's a sign that the selling pressure is increasing. Are the bear bars in the past 10 bars having bigger bodies than those 20 or 30 bars ago? More selling pressure. Also, are we no longer seeing consecutive bull bars? Are the bull bodies getting smaller? In other words, are the bears taking control over more and more bars and the bulls losing control? Within a trading range, both the bulls and the bears are fighting for a breakout. The bulls want an upside breakout, the bears want a downside breakout. A lot of times as the trading range is forming, you can assess the amount of buying pressure and selling pressure to get an idea of which side is more likely to win the fight. And it can help you anticipate the direction of the breakout and allow you to enter early. Bull bars are owned by the bulls, so every bull bar, I think of it as owned by the bulls. Here's a green highlighted area to represent a bull bar. Bear bars are owned by the bears. The more bear bars, the more selling pressure, the more likely there'll be lower prices that follow. The more bull bars, the more buying pressure, the more likely there'll be higher prices that follow. In a bull trend, the bulls are clearly in control and you should expect higher prices. In a bear trend, the bears are in control. They own the market and you should expect lower prices. Always in is a concept that I use when I'm trading. And what is always in? If you were forced to enter the market at this very moment, long or short, and you had to choose buying or selling, and you absolutely had to do one or the other, your choice is the always in direction. So if you look at the market and say, gosh, I'm not really sure, but 20 bars ago there was a pretty good bull spike, therefore I would buy. The market's at that point always in long. When the market's always in long, that means more dollars are on the buy side and the market's likely to go higher and you should look to buy. When the market's always in short, there are more dollars going into the sell side, generating more selling pressure. Lower prices are likely to follow and you should look for opportunities to sell. Whenever you know the always in direction, you try to enter the market in that direction either immediately if the market is extremely strong or on a small pullback. And if your stop has to be very far away, then trade very small. But make sure to get in. Whenever you feel confident that you know the always in direction, you really need to be in the market in that direction, even if you have to trade very small. For example, when the market had this huge bull bar, followed by 3 more bull bars, somewhere in here, most traders would look at that and say the bulls are controlling the market. The market's going to go higher. Look at this bar, this second bull bar here. Its close is above the high of the prior bar, so there's a gap. And also the low of the bar after it is above the high of the bar before it. So to me that that is a gap, and it may end up being a measuring gap. Signs of buying pressure: big bull bodies, consecutive bull bars, bars closing near their highs. Not everyone, but there are a couple here, very big bull bars closing near their highs. Tails on the bottoms of the bars, buying at the bottom of the bar. Here's another gap. The high of this bar and the low of the bar 2 bars later, or 3 bars later. Anytime the market is forming gaps between the low of a bar and the high of a prior bar, that's a sign of buying pressure, and it usually results in higher prices. Here's Baidu again, the same ticker that I used on the prior chart, and there was very strong buying pressure early on, but it was followed by a relentless bear channel. And at some point in here, you'd look at the chart, maybe not here, But over here, you start looking at the chart and thinking the bulls have lost control, the bears are in control, the market's probably going down at least a little bit lower. So somewhere in here, you're deciding that the always in direction is down. Look at these two bear bars here, and look at the low of this bar and the high of that bar. There's a gap between those, between that low and this high, and it could end up being a measuring gap. Here's another gap here. Again, a sign of urgency on the part of the bears. So what you're seeing here is big bear bodies, consecutive bear bars. There are 4 in a row here, and there are 6 or 7 in a row here. Bars closing near their lows, okay? Tails on the tops of bars, and gaps, bear gaps on the way down. The low of the prior bar is above the high of the following bar. Low of this bar above the high of this bar 2 bars later, so there's a gap in there. All signs of selling pressure, all signs that the bears are in control, that the market is always in short, and that you should be short at least a small position. When the market's in a trading range, it's mostly sideways. But within the trading range, if you notice more buying pressure, then a bull breakout becomes more likely. If there's more selling pressure, then a bear breakout is more likely. So it's important to try to assess the amount of buying and selling pressure that's taking place within the trading range. If buying pressure is dominant, you expect a bull breakout, and the market is probably always in long, even though the market's within a trading range. You know, always in means you have to choose. You have to take a position this instant. What would it be, long or short? And if you see more buying pressure than selling pressure, your conclusion is it's always in long. Okay, here we have a trading range, but within the trading range we have this very strong bear spike, but then look what's taking place over here. We have 3 consecutive bull bars. Look what happened to the bear bars here, right? You can say, well, it went down for 6 consecutive bars. It did, but here's a bear bar. Look at the follow-through, not a bear bar. It's a doji bar. Here's a bear bar. Look at the follow-through, a doji bar with a bull body, a bear bar, and a doji bar. So we have a bull leg here with 3 consecutive bull bodies, but the bear leg did not go down as far as the bull leg went up. You know, it did not reach the bottom of the bull spike, and the bears were no longer able to string together consecutive strong bear trend bars. And then over here, look what's taking place here. We have 4 consecutive bull bars, and the 4th bull bar has a bigger body than the prior ones, and there are gaps. This bar has a gap. The low of the prior bar above the high of this bar. The low of this bar above the high of this bar. So the market is starting to gap up. So yes, we're in a trading range, but we're starting to accumulate strong buying pressure. The bulls are starting to take control over the market. And this is what followed. So this is where we were. At that point, you thought always in long. Buy small, buy something, and put your stop below the most recent higher low, and take a chance that the market is going to go up, and go for a swing. You remember we had those 4 consecutive bull bars, closes near their highs with gaps, a sign of a lot of buying pressure, even though the market was in a trading range. So you don't have to wait for the breakout. You can wait for the breakout and then trade it like a breakout. I have a module that talks about how to trade bull breakouts, but within the trading range itself, if you're starting to see the market being taken over by the bulls, you can get long earlier because you decided that the market had become always in long. Here's another example of a trading range. Today occurred on a day with a gap open. We gapped down on the open, and then we had 4 consecutive bear bars. But notice what happened after that gap down and the bear spike. We formed a trading range, but within the trading range we had a series of 3 consecutive bull bars here, again here, and again here. Now look at the series of bear bars. You know, 1 bear bar here, 1 there. Where are the consecutive strong bear bars? Here are a couple here, but then a bull bar. Here are 4 here, but 2 of them had very small bodies. Here we have 4 consecutive bull bars, a bear bar, and then 3 consecutive bull bars. So 7 of 8 bars here have bull bodies. So we're, I think, accumulating some buying pressure. The bears want the trend resumption. They want a small double top bear flag. But look at the signal bar, a bull body, not good. Signal bar here, bull body. Something's wrong with the bear case. Bulls want a double bottom and a higher low major trend reversal. Right here, this is a higher low major trend reversal. They're trying to get a double bottom. You can call this also a higher low major trend reversal. Okay, 4 good-sized bull bars and good-sized bull bodies. For the bears, it's a failed breakout of the top of the trading range, a test of the gap, a double top with the first bar of the day. But look at the signal bar, a bull bar closing on its high. Not a reliable signal bar. We have 4 consecutive bear bars here, but they're small and a tail on the bottom of the bar. And they're also holding pretty much above the moving average. So the bulls are looking at this thinking that this is simply a pullback from this bull breakout. Look, we got a low. We have a low back here, a higher low, a higher low. The bulls want another higher low. We have a high, a higher high. We have a high, we have a higher high. So we're starting to get higher highs and lows. Bulls want this sell-off to stay above this low. So bulls are buying right in here, putting a stop below the prior higher low, taking a chance that this trading range is evolving into a bull channel. This is what followed. We had a bull inside bar, a reasonable signal bar for the pullback from this breakout. That's a reasonable long, looking for another leg up. And look at the strength that we had here. A series of 7 or 8 or 9 consecutive bull bars, and several of them large. So we had a bear trend, a trading range, and instead of resumption down, we had a reversal up. When there are more bearish footprints, the selling pressure is dominant and a bear breakout is more likely, and the market is always in short. Traders should look to sell. Here we had a rally on the open, and then we entered a trading range, and we had a good bull spike here, but a very strong reversal down. We had a tail on the top of the bar. We had a couple consecutive strong bear bars. We had small tails on the bottoms of the bear bars here. We had closes near the low, and little or no overlap between adjacent bars. And we also had gaps. Here's a bear bar, and look at the high of the bar after it and the low of the bar before it. There's a space in between, so a gap. Here's another gap. Here we're breaking out below the bottom of the trading range, and we have a big bear bar, and the high of the bar after it and the low of the bar before it do not overlap. So this might end up being a measuring gap. So the selling pressure, we had decent selling pressure all through this trading range, so it was pretty neutral. But when we started to come down here, the bears were getting stronger. Channels become trading ranges usually. Usually they become increasingly two-sided to the point that they're no longer a bull trend and the market is sideways. Bull channels, they get increasing selling pressure, and that is a sign that they may soon evolve into a trading range. A bear channel, when it starts to develop increasing buying pressure, that's a sign that it may evolve into a trading range. Here's a very strong bull spike, and then we're starting to channel up. Okay, 2 very big bull bars. This breakout, smaller bull bars. We got some smaller bars here, and now we're in a tight trading range, and we're starting to get some bear bars. So this might be a bull trend, a strong bull trend, a weak bull trend, a bull channel, evolving into a trading range as the selling pressure is increasing. Here are some signs of selling pressure. We've got some bear bars here, lack of bull bars here, increasing number of bear bars here. A wedge bear flag. We have a push up on this bull bar, another push up here, and a third push up here. Possible a lower high major trend reversal. We broke out of the channel. The bottom of the channel is a bull trend line, so that means we broke below the bull trend line. And now we have a weak rally in the form of a wedge. So this might be a lower high major trend reversal. A bear bar, so a possible signal bar for a short. And this is what followed. We had a bear spike, certainly tradable, and ultimately our bull spike, our bull breakout, was followed by a bull channel that evolved into a trading range. So the channel usually becomes the first leg of the trading range. So a bull leg, and then a bear leg, and now a bull leg. This is some buying pressure in a bear trend. We're in a bear channel. We're forming lower lows and lower highs. And it's a pretty strong bear channel, but we might be getting a third push down. 1, 2, 3. So it's possible, effectively a wedge. Whenever you get a low 2 short, here's the first push up, second push up, so that's a low 2. When you get a low 2 late in a bear trend, you always have to be thinking about the possibility that it's the final flag in the bear trend. So traders will look for a reversal. Here's a 2-bar reversal, a bar down and a bar up. So a possible buy. We got 4 consecutive bull bars here as well. And a 6-bar bull microchannel. 6 bars without a pullback. So we're starting to develop some buying pressure late in this bear trend. The bears saw this as a bear flag, but instead of getting a bear breakout, we're getting a bull breakout. So aggressive bulls will buy the close of this bar, and they'll also buy the bar as it's forming, and they'll put a stop below, betting on a successful breakout and a measured move up based on the height of the bear flag. The first target would be a break of the top of the channel. This is what happened. We had a very big bull trend bar, small tails, close on its high. Traders will buy that close as well and put their stop either below the low of that breakout bar or below the low of the beginning of the bull spike, the bull breakout. So we had some buying pressure at the end of a bear trend, and it led to the start of a reversal up. And this is what followed. Traders bought the close, a very, very strong bull spike, and traders began to treat this like a strong bull trend. Yes, we're starting to get a pullback here, and we're probably evolving into a channel, but it's a bull channel after a very strong bull spike, so the odds are high that there'll be higher prices that follow. So traders will be looking to buy. Stop maybe below here, maybe down here into this gap. The low of this bar is above the high of the bear flag, so we have a gap in here. That's a breakout gap. This might be a measuring gap, a very large bull bar. And that is the end of the module on buying and selling pressure. Thank you.